Okay, so lastly, this is the final class which is push the cherry on the top of the 2 years journey in the field of finance. And I like this course really much because I enjoy to work with you during the semester and also during the previous semesters. But on the other hand, I'm so exhausted now. And I think that it's funny that I'm talking about exhausted, and you start the exam period soon, and you have to work on your thesis, but also on my terms. I was also working hard, and now I would like to present you the last two chapters of this book. So first, I would like to talk about liquidity risk, because finally, liquidity management part of Basel III is now operational. So I asked one of my friends who is working at one of the major Hungarian banks at the treasury, and he told me that now they have to meet with all the agenda what we have to study here today. So because it was like a never-ending story that they wanted to introduce it already in 2019, then COVID came, and it was always abandoned, that when fully they have to make the transition here and there. So first of all, I would like to talk about liquidity risk, and the next thing will be about operational risk. So what is also the regulation there, because Basel II introduced at least 3 different standards. Then in 2016 they realized that now they had 3 different agendas in the whole banking system, and it was a mess, so they unified them, which is still not widely adopted, but so we will see these things. So first of all, we have to distinguish between solvency and liquidity, because before 2007 it was the general impression that if a bank is solvent, so practically the value of the asset is bigger than liability, so practically the equity value is positive, then they are liquid. And then the 2008 crisis came, and we know that the liquidity is another different specific animal, and that's why Basel III requirements started to arrive. Because practically liquidity is the ability to make any cash payments as they are coming due to pay. And also for banks, liquidity needs are much more uncertain than for usual companies, because banks are running this maturity transformation, so mostly on the liability side they can have short-term liabilities. So that's why it can be important, and that's why Basel III tried to regulate all of this thing. And at the level of trading, this thing is spiced up with the bid-offer spread, which makes everything much more complicated, because practically you have to be able to sell the assets. So that's why it can be more interesting. And also, if we have any kind of option or other derivative, then also the underlying market should be liquid as well, because otherwise we are not able to hedge, at least we are not able to achieve delta neutrality. So not just bid offer, not just delta neutrality, but also this uncertain liquidity needs are the 3 horsemen of the liquidity apocalypse. So yeah, liquidity trading risk. So the book is going through all the different aspects here. Practically what they are saying that, okay, if we would like to sell something in higher quantity, obviously the bid-ask spread starts to increase. And it's so funny. I know when I was a PhD student, she was also a PhD student at the Corvinus University. Now I think she's also an associate professor nowadays. She had this beautiful maybe GIF file, so some kind of animation, when she was able to show us at a liquidity conference in 2013 that when market trades were happening at the Hungarian Stock Exchange, practically you were able to see that this bid-offer spread was increasing. So bigger transactions had way bigger influence on prices, even in blue chip companies. And if you are going down to middle enterprises at stock markets, this thing is even much more much more important, because the trade volume is way smaller, and that's why it can be even further enlarged. And obviously the key problem is that how can we convert things to cash? Practically, if we have to fire sale a position and convert everything to cash, obviously it will have this quantity bias. So the book will provide us a solution that how can we optimize the quantity problem. At least they provided a solution, but practically it was not a numerative solution, just they provided an equation. So it's not that easy, but at least we can see that what are the components of the function there. And obviously, if we are talking about non-investment grade bonds or things at emerging markets, it will be more and more complicated. So yeah. Okay, oh, and then there will be predatory trading. So if we know that someone can be forced to sell a long position or close down a long position sooner or later, then we can build up shorts against it. This is predatory trading, obviously, because usually I hate when some people are saying that on the stock market or on bond markets or generally on capital markets, what you can earn is someone's losses. This is not the case, because the whole cake is growing because economy is growing, so that's why share prices are increasing. It's not increasing because someone was losing money, but it was increasing because the companies are increasing their productivity, and that's why they can grow, or at least their profitability will rise somehow. Or if there is a recession, then the whole cake is shrinking, because somehow they realize that maybe profit making is not that great as they expected before. But in terms of predatory trading, yes, in this case, this is a zero-sum game on the short run. Obviously, building up short positions, it's also a risky thing, because if it's not successful, then and when they have to give back the shares, then they can suffer losses, and they have to run it from leveraged positions. But okay, that's their problem. That's why, if you are working in the future in any kind of regulatory commission, you should never forget that if you have to force a company, or sorry, a bank to get assets through fire sales or mass liquidation, this is never the way. So it's much more efficient if you let the company cool down nicely. So when long-term capital went down in 1998, they were responsible for more than half of the options market globally. And in this case, the US Fed was really wise, because they were saying that, okay, they sold the whole hedge fund to different investors from the banking sector, but they were not forcing to close down the position. And at the end of the day, they were closing down, so they were letting the different derivatives to run out until 2001, and they were able to close down everything with a profit. And a similar thing happened in Switzerland in somewhere between 2008 and 2015, when all the bad assets of the Swiss banks, mostly overseas assets, were delegated and bought up by a bad bank. And practically they were able to sit down, relax, and let's wait. This bad bank was owned mainly by the central bank, so we could say that, oh, but it was using up taxpayers' money. But since they were able to sit down and wait for the closure of all this and run out of this contracts and mainly bonds, securitized bonds, they were able to close this business down with a profit as well. So fire sale is, if this is the option, then yeah. And also, if we have to do this, these fire sales, then it can have spillover effects. So we will force this crisis through more and more markets, so practically we are not able to contain anything. Maybe this company was secured because now they are liquid, but now we created a widespread effect. So yeah. Okay, importance of transparency. Also, they realized in 2007 that maybe investors should understand that what they are buying right now, and not just retail investors, but that was the problem of wholesale investors, wholesale markets. So when they started to purchase subprime instruments, as you were able to see these different CDOs, ABSs, what I was trying to model last week, then practically you need some kind of information what is behind there, and also if we have derivatives which are emulating these portfolios, then still also we need information. So on the other hand, if you are checking the data, nowadays, for example, mutual funds are forced to create these monthly portfolio reports. This was not the case before 2007, so this is a new thing. Before of that, they had to publish the value of the fund, and they had an annual report, and that's all. So, for example, we can find this influence as well. It's also not related to the transparency because MiFID was introduced, at least at the level of legislation, it was introduced before the 2007 crisis, just it started to become active at the same time, so we could say that it was also the product, but it was not. So it was an earlier thing. Then practically you have to evaluate also the clients, that who can buy this asset, who has a specific knowledge to buy this asset. Okay, since then it's really funny when I would like to, so this week I purchased some government bonds, my broker, or it was a mutual or whatever, so I was buying at one or two subsidiaries of my bank, and still I had to define that, oh, I have the specific knowledge, so I have to answer these questionnaires, that I can buy government bonds, and come on, I'm an economist, but still I can be stupid. So, okay, but now at least we can say that at least there is a filtering between the clients, that who can buy what. I had no idea about the efficiency because I was never able to find any papers on this field. Mostly I was never looking for it, but at least it should come sometimes, so it should pop up here and there. But it will be really interesting to see that what happened with this MiFID regulation. Okay, but let's come back to here. Measuring market liquidity. So there are different approaches, but everybody in the market uses this bid-ask spread. The book somehow says offer price, but even I had a whole PhD student. So even I had a PhD student who was writing his thesis in the field of bid-ask spread. So you can write an entire thesis about this and how we can define that it's changing back and forth. So yeah, and also sometimes, so if this is just the difference, then this is the dollar spread. If we are talking about that we have to divide it with this mid-market price, then this is the proportional bid offer spread, because sometimes they are using this one, sometimes they are using that one. Practically the mid-market price is that they are taking the average between the two of them, and they are just creating a ratio or a percentage. And why this alpha is important, because at the end of the day, cost of liquidation at a normal market will be defined by the sum of these bid-ask spreads. And what I like that practically this is when they are starting to introduce the stressed market concept, because so okay, usually the liquidity risk is not an important issue under normal conditions, because there will be liquidity. The problem is when there is no liquidity, so that's why stress tests are quite popular among governments. The problem is that before COVID, maybe, yeah, we were with Mercedes in 2019 at the conference in Warsaw, and some people from the National Bureau of Economic Research who was working at the US Fed, and he was responsible for the development of the different stress tests where they were analyzing the liquidity risk. And he was telling us that okay, these stress tests are really good, but when we are testing the stress tests, sometimes or things were quite arbitrary, because they have to make up things to make these things work. So mostly the problem is that it has a modeling risk inside. So stress tests are good, but yeah. But at least here we can see that yes, but if we are saying that okay, let's have at least an assumption that what is the usual bid-offer spread, what is the standard deviation of this, so how volatile is this thing, and also let's add some confidence level. So if romantically we are assuming that this is has a normal distribution, then practically we have a bigger number here for cost of liquidation, and after that we can say that yeah, let's create a capital reserve to cover this position. It will be higher than this number, so practically we will be much more conservative, and the aim is to be conservative in case of risk management, so it will be good. Practically, if we are saying that okay, but it's not a normal distribution, then still we can say that okay, let's put theoretical distribution on this data, and after that let's look for the standard deviation above the mean level, so what is happening with 99th percentile. Then we just have to grab whatever at the x number is, because in this case the empirical distribution will define this, and after that still we can calibrate the model. Obviously the tail risk is always the problem that it's hardest to measure, because there is a small number of empirical data points when we have to fit, and the next rises maybe we'll put 3 more, and after that the tail will be longer if we are unlucky, or it can be shorter if we are lucky. So in this case our conservatism can secure us. Okay, and after defining that how can we measure market liquidity, we can say that oh, we can create this liquidity-adjusted VaR, value at risk. So practically we are using already our value at risk, and we just add this number to it. So nothing new is happening, as I mentioned that we get this number. This is what we can lose if liquidity is going south. So let's add it to the already existing value at risk matrix. And after that, things can be a bit more complicated, because how can we close down a position? So this is the quantity issue, what I mentioned, that okay, if we are selling out everything immediately, so we are doing this quickly, immediately, in real time, then there will be a large bid-offer spread. So we will face the consequences. But also at the same time, at least we know that what is the price. Just if we are facing with a 1987 scenario, when practically the on an nice October day, there was a wave of fire sales at the New York Stock Exchange, and also at the derivative markets in Chicago as well. And what happened, that the book was full of offers. everybody wanted to sell because they were seeing that, oh, the market is falling, and it was like falling more than 15%. But practically there were no trades because nobody wanted to buy. So in this case the market was freezing. It was freezing literally because also at the same time it was an electronic trade, but still we are in the late 80s, so computers were not able to process after after they were able to full of data. So it was a issue of computing process, but also mainly it was the issue of the trading books, that there were no other side. So we can say that until some levels the mid-market price will be small, but if we are doing this at a too big, or the quantity will be too huge, then we will lose the bid side, and then there will be just selling offers. Or if we are sit down and let this thing unfold slowly, then obviously the bid-offer spread or bid-ask spread will be lower. Just in this case we have no idea what will happen with the prices. So yeah, there is a trade-off. Here maybe we have no chance to maybe sell the asset. Here we have the chance to sell the asset just at lower prices. Yeah, this is life. Okay, so what is the optimal way? And if we have some units that we have to liquidate, so this is V, then we have to split it to Q units. So they are identical, so we are selling the same amount of quantity in each day for a nice P amount of dollars. Then practically the size of the trader position at the end of the day will be this X number, which at the beginning it's V, and after that it's gradually slowly decreasing down by these Qs, so as we are selling these Q packages. So practically each trade costs half of the bid-offer spread. So practically we have to say that, okay, we have this quantity and we had this price impact. And if we're assuming that still price changes are happening with the normal distribution, with standard deviation of sigma for each day, then practically we can say that the price influence will be this volatility and the still available quantity. And if you would like to optimize this one, then we have to solve this, but we cannot do numerically because there is a feedback between, so Q is here and Q is there and there as well. So at the end of the day we can use Excel solver or MATLAB or other approaches, but practically this is the way. And in this case this 2.326 is obviously the 99% of confidence interval here, that what is the probability of losing that much. So this will give us the optimal quantity. So how can we calibrate this? Obviously what will change here is the standard deviation. So if the standard deviation increases, obviously the bigger number of square root still is a bigger number, and practically this will also bigger. I don't think that there is such a feedback, so mostly this is driving things upwards. Or if the position is big, then also you can have a feedback, just the position will be managed by the Q, so this thing is deflating. Yeah. Okay, but there is another measure of market liquidity. So this paper is cited, or at least popular according to the book. Practically if you are taking the absolute volume of the daily return and dividing it with absolute value of daily return and divided with the dollar volume, then we can get also the assumption about market liquidity. This is also used by people, but somehow bid-ask spread is much more popular. Okay, so liquidity funding risk. Here the book started to provide huge lists of many things, so I started to compress this thing down and to look for the significant components. So liquidity funding risk means that financial institutions' ability to meet its cash needs as they arise. So we have to pay your client because we don't want to be in a position what happened with Credit Suisse recently or with other US banks. And I'm not talking about the Kramer curves that once Kramer is telling that this asset is safe, then suddenly the share price starts to fall down. But this is a practical thing. So how liquidity funding problems can appear? So first of all, if there is an overall liquidity stress at the economy, so there is a flight to quality. What happened in 2008 after Lehman Brothers collapsed, that gold became popular, Swiss franc started to become popular, any kind of government bond which is AAA rated started to become popular because this is safe asset. And since then central banks are trying to force investors out from this safe haven assets, and this was leading to the quantitative easing and unconventional monetary policies. So at least monetary policy can do something with this. Overly aggressive funding decisions. So when we are using too much short-term instruments to fund long-term needs, yeah, but also at the same time, this is one of the main objectives of running a bank, that you have to make maturity transformation. So, but also Basel III is trying to motivate banks to create a mismatch. To maintain or restore some kind of mismatch, that okay, if we have long-term assets, then maybe it should be funded much more by long-term liabilities, and yeah, so create some kind of parallel structure if it's possible. Poor financial performance leading to lack of confidence. Yeah, so classic Credit Suisse case. Loss of deposits and difficulties in rollover funding. This is when we have to sell the banks, we have to liquidate the assets, sell its assets, do something with them, because yeah, if the financial performance of a bank is bad, okay, it can be the macroeconomic, or we can trace it back for macroeconomic reason, or maybe it's just rubbish. So it can happen. Hedging issues. Yeah, they were hedging, just they tried to do this with illiquid assets, and it was maybe not the greatest opportunity, or maybe they provided hedging services, but still it was not efficient. So it can be a problem. Or they had contracts that are subject to margin requirements. Practically also the same thing can happen under hedging. So if you are hedging with forward contracts, then there can be margin calls, and you have to meet these margin calls, otherwise you are losing your forward or future positions. So practically these two things are the same, but okay. Okay, what are the main sources of liquidity? So cash and treasury securities, they are excellent, just obviously the profitability is not that great. So cash has nothing, absolutely, and it can be burned up by inflation. Treasury bonds, bills, notes are nice, just in the last, or during the last 1.5 decade, their profitability is nearly zero, or sometimes even negative. So yeah, it was also bad for banks' financial performance when they were not able to realize any profit on. At least it was not. At least right now we are not able to see that low interest rates or negative interest rates in safe assets was leading to a risk appetite in the banking system. Because usually during the 90s it was always the recipe that, oh, interest rates went down, then they started to purchase everything which is risky, because still we need some revenues, and after that, during the next crisis, they went down miserably. So it happened in level of countries, it happened level of banks, it doesn't matter. So the story was always the same. At least right now, maybe this is not the case. Well, okay, 5 years later we can decide. Liquidate trading book positions. So this is fire sale, which will be a problem if we have to do it already in stressed market conditions. Borrow money at short notice. So you have to look for someone who will give you money at a stressed market. Good luck with that. Or you can do it with really high interest rates, and then it will clear your profitability even more, so you can go down in the deadly spiral. Attack retail and wholesale deposits. Obviously, just the problem is that other banks are trying to do the same thing, so you are fighting for the same liquidity supply. So obviously, if there is a liquidity scarcity on the market, then interest rates will go up. And you can run securitization. This has happened until 2007, and since then it's still happening. So that's why we have designated asset purchase programs even at the European Central Banks in 2014, because they realized that they have to manage this market to stabilize it, and they have to add it to the list of their monetary instruments. Just the problem is that also if there is a stressed market, then it will be harder to do this, because already market confidence is far away, and also it happens that even you are outsourcing some assets from your balance sheet, so there will be off-balance sheet vehicles, and these special purpose vehicles will be used, but still you have to provide them. So you have to operate them, even if you're not supposed to, but you are motivated by everybody. So at the end of the day, that's why we have central banks. So we can say that without central banks, things would be much more messier. That's the reason why this institution was created more than a century ago. So because borrowing from a central bank, okay, even if we have to pay a haircut, so obviously we will not buy it at market value, they will be conservative, but anyway, if we are using collateral funding, there will be always a haircut. It doesn't matter that we are working with the central bank or with other bank or with someone, so haircut will be there, and maybe it can have higher rate of interest. That's why central banks introduced asymmetric interest rate channels. Also they introduced the lack of limits for short-term lending already in 2008 and 9. So this relatively high rate of interest, yes, the rate of interest have to be above the interbank market interest rate, but on the other hand, if they want to manage it efficiently, then usually they are pushing it downwards, because this is how they are trying to influence things, if their monetary policy transmission is efficient enough. And of course, reserve requirements can be defined by central banks, and it can fluctuate between 1% and 10%. So under crisis situations, under liquidity scarcity, it can go down to 1%. In usual peaceful times, it's around 3 to 4% at advanced economies. The book was saying 10%, which is usually not the case. So 10% is when there is a liquidity surplus and you are not able to do anything with this money. So you are pushing the banking system to put this money as a deposit into the central bank, and then you are removing it. And that's why at 10%, mostly this is sterilization. It's not a reserve requirement anymore. In this case, you are fighting against inflation. So, yeah. And this is what my friend have to calculate nowadays, at least since January. But before of that, they had to calculate already. But now they have to create these capital requirements as well. So we can see that there is a ratio now between high quality liquid assets and net cash outflows within a month. And it's really funny because it was 11, 13, yeah, it was 2013 when it was also a conference, and there was my favorite vice president at the Hungarian National Bank at that time. Since then she is not working there, unfortunately. And she's also a really good researcher, Julia Király, and practically she was saying that okay, this is a really good thing, but banks will hate this because practically they have to reorient the structure of their whole balance sheet. So it's not just that, oh, let's define this one. So after that you are forcing the whole treasury to to run the business strategy as a whole around this two ratios. So that's why they are trying to push this. So we can see that, yeah, in 2015 already they tried to do this. Then this did not happen. So it was introduced only in 2013, but 2023. So practically it was introduced only one decade later than than the conference when she mentioned that banks are not that satisfied, but also at the same time, yeah, but when there is a liquidity scarcity, then they would be so happy to have this. So it's always an obvious moral dilemma that, okay, from profitability point of view, this is a bad thing. From a macro stability point of view, these two things are heavily important, because there is also this net stable funding ratio was this amount of stable funding. So they have to create all these many different capital categories, so capital, wholesale deposits, retail deposits, and so on. And after that they have to multiply it with the factor defined by law. And also there is this required amount of stable funding, so assets and off balance sheet items required funding, so practically asset side and behind the sources behind these assets, and also there is a factor which can multiply these two things, and it should be above 100. So this is a way more conservative approach than what the bank gets used to since the 80s. Okay, and also the Basel Committee defined principles how banks should manage their liquidity. So for me it was quite obvious that banks should do things like this. So sound management of liquidity risk, that they have to create cushions, they have to articulate their risk tolerance, so they have to understand that what is happening with their liquidity conditions. Senior management's work is to understand that how strategy, policies, practices can affect liquidity risk, and what are the cost, benefits, and risk of liquidity. They have to create processes, monitoring ability to deal with liquidity risk. They have to have efficient diversification of the sources. They have to understand and determine their intraday liquidity positions. They have to have stress tests to understand that, okay, what happens if things are going downwards. And they have to have, that's why, a contingency funding plan, that what happens if things go wrong. And they have to have this cushion for unencumbered high quality liquid assets, and also they have to disclose information. So come on, if you have a bank, you have to do this. Now the special thing is that you have to have business processes and you have to be transparent about this. But otherwise, if you were not able to solve this, you were not able to run a bank even under the medieval time periods. So or even during the Bronze Age, it doesn't matter. So these are generic banking features at each bullet points. Just now we can call a regulation, and also nowadays we have computers. So that's the thing when people are talking about fintech. And the benefit of fintech is not that they can remove the banking system or they will create a new banking system, because the problems are same things for centuries or millennia old. Or maybe if you would go to another star system and you would find their intelligent species, their banking system would face with the same problems because the logic is quite generic or general. So in this case, fintech can happen or can help here and there. They can optimize here and there. They can help to provide data, help to mine data. But at the end of the day, they just create more sophisticated procedures. That's all. Okay, and also the book is talking about this liquidity black hole. So what happens under a crowded exit or fire sale? That situations where liquidity has dried up in a particular market because everybody wants to sell, sometimes wants to buy, and at the same time no one wants to buy or sell an asset. And unfortunately this is an increasing tendency since the 80s. I remember when reading different interviews during the early 90s when all the electronic trading was introduced, that they were saying that okay, but liquidity risk can be an issue. But at that time there was this liquidity illusion that it's not a problem. Just since then it's a problem. So that's why if there is no IT background, if there are no sophisticated models, then the frequent liquidity losses can kill a bank. So it doesn't matter that what is the rules of operations or engagement. Okay, and positive, negative feedback. So what are the what can possibly go wrong? So trend trading, everything is going down, so that's why we are building this thing up. Stop loss rules. When we are forced to sell, even if we understand that maybe markets can go down, then it can create also fire sales because everybody set the stop loss positions at the same places. This is what technical traders are trying to exploit when they are using these Fibonacci numbers to create this stop loss layers. I think sometimes this is much more like an esoteric thing, but stop loss rules are happening, so sometimes we can see that markets are freezing down, just maybe not at under Fibonacci numbers. Dynamic hedging. When dynamic hedging is losing its dynamism because you are not able to continue or cover the long-term option with short-term options. So it can be a problem for you. Creating options synthetically, practically they are the two things. Margins, if you are not able to put additional collateral, then you have an issue. Predatory trading, you see someone is going down nicely, so you are trading on it, which is legal, obviously, because otherwise there would be no liquidity on the market, or even less liquidity would be on the market. Relative value fixed income thing, when you are taking a short position a liquid bond and long position a similar illiquid bond and wait for the prices to move close to each other. But what happens if they are not? then